Good morning, afternoon, or evening, ladies and gentlemen, all in crypto here, and welcome back, guys, for your daily cryptocurrency market update. For those of you that may be finding this channel for the first time, every single day at 1 p.m., we released an in-depth market update where we don't just look at the cryptocurrency markets, but we look at the markets outside of it and really the macro landscape. We've all kind of had to start paying attention to the macro, and it's very interesting because last year, and really always, perhaps barring maybe the very early days of Bitcoin, the cryptocurrency market is tethered to liquidity. All markets are tethered to liquidity, of course. When you're looking at Bitcoin, you're looking at Bitcoin against the dollar or another fiat currency, typically. And this is really what we mean by liquidity. And this is something that we have to watch as we're very tethered to. We're going to be doing that in this video. We'll be looking at the Treasury's next steps and how, talking about the US Treasury's next steps and how this may affect liquidity as they look to build their cash reserves back up, having dumped them in order to get this debt ceiling passed that has now been written into law. So we'll be looking at that. We're going to be looking at Bitcoin's price. I think you're going to get quite a lot of moving average traders. Beware of the moving average traders, guys. I do think moving averages can be useful when you're looking on a big time frame at perhaps where a market is and you know, is there relative strength here or not. That's kind of how I use the moving average. When you're below it, you know, typically that's not a great sign. And when you're above it, you know, it can be quite positive. Certainly if you're where it is right now on the 200 weekly moving average and you're sort of holding that support. Now, I won't trade the weekly moving average. We've got method for trading that is pattern based, price orientated. However, it is interesting, and I think you're going to get a lot of MA traders coming in now. Ultimately, you guys know that we've been long and strong since the start of the year. We're going to be reiterating that, and we're going to be looking at rates. And then, of course, the week ahead. So this is going to be a jam-packed Sunday fun day market update. So strap yourselves in, guys. Without further ado, let's get into it all. Now, let's start off with the Bitcoin chart. What do I mean by moving average traders? Well, the 200 weekly moving average, I don't think you can trade MAs necessarily, is and has been a pretty historical, and I'm sure if we brought up the Brave New Liquid Coin Index, which has further history here, which we'll do actually. Not sure what funky draws I've got on here, of course. So this was probably us looking at the halvening, where we are now, and the halvenings that take place. Remember, Bitcoin's got another halvening coming. The 200 weekly moving average has been a good support level. And if you look at where Bitcoin currently is today, it's holding support. So this is what I mean by you're going to have an influx of probably moving average traders coming into the market. And remember also, this is just good job I brought this up. You know, you guys know that I come from the school of Fourier cycle theories and the halvening, and this is what's driven Bitcoin. But actually, there's always been this kind of macro environment. Bitcoin's always existed, and it's explainable why for the first time we went and stayed below the 200 weekly moving average in a quantitative easing environment. Quantitative tightening is the first kind of environment that it's suffered. However, we do think, based on all our reasons that we've gone over, you know, looking at interest rates, looking at the macro drivers, and when we suspected a change going into 2023, we took the plunge on the 5th of January to buy crypto for the first time in nearly a year. We do suspect that the macro environment's changed. In yesterday's video, for those of you that have missed it, the daily market update, we did look at the S&P and rates. And remember, markets went pretty ape when you had rates going from 75 basis points down to 25. I think they're going to do pretty well under no rate hike. We are still in a pretty tight environment, but there's a lot of contradictions with that. However, we do have, and we're going to look at some of what the Treasury is going to get up to. We've commented on it before, but there's a lot more coming out and actually action being taken in regards to the Treasury now dumping billions worth of Treasury bonds. This is important for me as somebody who watches the bond market and idolizes it very much, because yields are what leads the Fed funds. And if they're dumping bonds, that means yields are going up, typically, unless there's that demand there. However, there might be an increased interest in the bond market given the kind of interest rates that are on them right now. That being said, before I get into all that and before we look at the week ahead, we look at rates, we look at a few interesting things. You know, this is rates and where potentially they're going. We're going to look at non-farm payroll because it's just crazy what's going on. We also had unemployment that we touched on yesterday. Markets are positioned to do well. This is something that we've been saying for a while now, and actually are very confident in that at this moment of time. I think you could have a new all-time high for the S&P. Go and look at historically what's happened. Do it very, 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 very quickly, guys. Under rates. sideways rates, sideways rates, sideways rates. You know, even if going more historically back, you know, this is the period where rates went completely sideways. Again, point of pause. You know, you can go right back. This is analysis that you do not get on other channels, ladies and gentlemen. So make sure you smash that subscribe button, leave me a like and a comment, and share this video around to as many people as possible. But we do think that the S&P looks pretty damn good. Technically, maybe this could be an inverse head and shoulders that takes you up there. We think the NASDAQ looks good, and we think gold's on the precipice of breaking out and going on and smashing new all-time highs, and actually is likely going to have a very explosive run as a result of it. We think the dollar will eventually roll, but this is going to be very correlated with the bond market. Bond market worries me a little bit, certainly the yields, because this is ultimately the leader for the Fed funds rate, and we want this to start rolling. You could have potentially just closed this gap, and now you're going to roll, but we will see. If this goes on and starts putting in highs, certainly gets above where the Fed funds rate is right now at, 5.25. We need to worry, because ultimately that could indicate that there are more rate hikes coming, and that's of course a liquidity destructive factor, and it's really what's driven the markets. Go and look at rates, go and look at the 2-year yields and Bitcoin. We've done all of this in-depth analysis previously, guys, or just use the S&P, for example. You can see this front run rates, and you can see this is where you had all your divergences, by the way. And then actually, as this has gone up, markets have come down. And as you see in this kind of topping period, markets have caught a boost on that. So bond market's very, very important to watch. You guys will all be well aware of that, daily followers and subscribers. So we do think Bitcoin's set for more breakups. We've been looking at altcoins. I did an in-depth, or I looked at certain altcoins that were suggested by the Patreon members. If you guys want to join the Patreon, link in the description. Try it out for a month. It's not for you. It's not for you. You'll get access to my portfolio and everything else. Let's talk about, obviously, the debt ceiling has now been passed into law. Biden signed it into law. With the debt ceiling, the Treasury, who are asking for the money, Yellen, of course, they've been dumping their cash reserves, because how can they go to the Senate and say, we need to up the debt ceiling and have a shitload of cash sat in the bank? Doesn't work like that. So they've been getting rid of them. They're now going to replenish them. The last time this happened, actually, we had the repo crisis. People have compared this to 2019. It's not 2019. And I'll tell you why. This is why macroeconomists, I think, often fall short. Anybody can be an economist. Okay? It's like trading, right? There's no specific qualifications, but the proof should always be in the pudding. Certainly from a trading point of view, we have things called P&Ls, which we all track. And actually, from an investment point of view, it's quite obvious to prove whether you're any good or not. And of course, verbally listen to what people say and are they accurate or not, and are they on the side of the trend. That's the main thing from an investment point of view, is being on the side of the trend. Bitcoin and crypto are in this overarching trend of a technological revolution that's going to go into the stratosphere and become worth tens of trillions of dollars. But within that, there's short trends and cycles that we try and catch. So the last time this happened, 2019. And they started replenishing their cash reserve. They got it from the reserve repo market, the reverse repo market. Now, there was only, I think, a handful of billion, a couple of $100 billion in the market at that time, and they drained it, and that's why we had a clog up. Today, there's 2.4 trillion. So even if they do need to get $1 trillion, there's ways for them to get that. It is going to have a liquidity sucking up event in certain areas. The question is, does that transfer over to the equity market? Now, potentially, there was a stock trader talking about that, and this could be the case. If you do look at the SPY, it's at an interesting point, right? Isn't it? Potentially double top. You got resistance here that's very clear. You want to be careful. But at the same time, just like we said, there's resistance here. We also said don't bet against it, because you're against what we believe is now the trend, an uptrend that's in place. So we have actually seen some movement in regards to the Treasury. The Treasury is dumping about $170 billion worth of Treasury bonds on the market on the 5th of June. I think there's more coming next month. Cash-strapped Treasury Department sells one-day bills for the first time since 2007. So they're trying to get money here. And this is going to take liquidity out of the system into their balance sheet, and they've largely been offsetting quite a bit of the QT that's been happening because they've been dumping cash for the past 6 months. What have the market's done? Remember, it's all a liquidity game, and this is why these things are important. One of the big things for me is watching the yield market and seeing what that does. 10-year yield, for example, is basically the dollar. Let's get the old Dixie Pixie up. This leads the dollar. Now, this had a bit of a rest. Dollar's now having that. I'm hoping the dollar comes down a little bit more, obviously, for my own bias and thesis, but we'll always admit when we're wrong and constantly looking at this. I think that this is likely going to come down, that eventually the 2-year yields. I think you could even see it come down to some pretty interesting levels as we see lower inflation, so on and so forth, which, of course, is what the Fed is fighting against. We think true inflation has it right at 2.7-ish percent, 2.8% inflation, whereas the Fed's got it at 4.5. So this is really something important to watch. We, of course, had non-farm payroll, which gave everything a bit of a boost, certainly those markets, the dollar. However, isn't this interesting? Just to put things into perspective now, this is from Bilaji. Streaks of better than expected non-farm payroll reports from 2000 to 2023. Remember, we've lived in a very, and this is why it's one of the hardest environments to try and predict, and many people are getting this wrong. So I think the bears haven't been able to see this pretty damn good in terms of percentage returns rally that we've had since the start of the year that we caught. Again, we only differ with the bears on timing, nothing really much else. But isn't this interesting? And actually, I think there's a lot of phoniness in the inflationary stats. I do think that inflation is a lot lower than they expect. Despite the non-farm, we still have a 74% probability. And remember, CPI comes the day before. We've got PPI the day of the rate hike, which is in 10 days and 6 hours. No hike, markets will do well. A hike, I think the markets won't actually act that badly, but they may draw down a little bit. Certainly, you've got some markets at key levels of interest. We think gold will reassert eventually. And really, guys, as investors, and this is why it's absolutely valuable to subscribe to this channel, because we do a lot of it for you, you've got to pay attention to everything going on. Because in this environment, the markets and the participants, it's not just to sit back and enjoy the ride. They're looking for reasons to have to change what they're saying. So if those are given, you'll see big change in the market in regards to things going on the macro. Maybe there's a banking flare-up, maybe who knows what it is. But we need to watch this very closely, and on this channel, of course, we do that. So looking ahead for rates, this is projected rates. So you can see cuts coming towards the end of the year, and then them coming back down. Now, pivots typically are not great for markets. However, they can initially be up until the point where they have to drop them fast. So a fast drop in rates usually is accompanied by something breaking. So this is all stuff to watch. Sideways rates, we know that markets do well under. Going into a pivot, sometimes they can do quite bad. Although, if we look at 2019, they actually did well for a while. And then, of course, we had the drop, the something 19 drop. So yeah, but let's look at the week ahead, guys, because this has gone on for long enough. All stuff we're watching. This is going to be a week ahead. Monday, you haven't got a great deal coming out. You've got US ISM servicing PMIs, which may be interesting. Expecting a slight rise, which isn't particularly which is a good thing in this case. You've got on Tuesday, the Royal Bank of Australia pausing their rates at 3.85. So we've already got banks pausing at this point. It's potentially why we're seeing dollar maybe gain some strength over these, certainly the Aussie. UK construction PMIs, pretty much stagnant, but a bit of a downside. Canadian Ivory or Ivy PMIs expected to fall. Wednesday, we've got the Australian GDP, we've got China trade data, Bank of Canada rate decision. Rates to hold at 4.5%. USEI crude oil inventories, we've got US initial jobless claims, that'll be interesting. And then we've got China inflation. And then we've got Canadian unemployment. Or employment, sorry. So not a massively busy week. But then rolling on from that, you've got CPI, you've got PMIs, and you've got the rate decision. So this is stuff we need to look at. We'll look at where the market is at the end of next week, of course, and update you on it. On that note, guys, I'm going to love and leave you. Please do me a massive favor. Leave a like, a comment, and of course, do subscribe if you're not already, and stay tuned for further updates. And on that note, I'll really love and leave you. Check out the Patreon, guys. If you think it's for you, please do join. If not, no pressure at all. We want people who want to be there, not people that feel like they have to. I love everybody all the same. And on that note, I'm going to love and leave you. Have a good Sunday, guys. Enjoy your roast dinners. See you in the next one.